Hello, good afternoon and welcome. You've tuned into Mutual Fund Corner on CNBC TV18. I'm Vinny Motiwala in the Mumbai studio. Today what we'll focus on and discuss is going to be multi-asset mutual funds. We'll try and understand how they're actually different from other mutual funds, what is their importance, what are the risks, and what are the factors that actually come into play for these multi-asset mutual funds, especially given that we're seeing that the current equity market situation is quite volatile. We'll discuss all of this and the risk associated with the funds with Santosh Joseph, who's the CEO at Germinate Investor Services. Thank you so much, Joseph, for joining in with us this afternoon on CNBC TV18. It's a pleasure having you on the show, Mr. Joseph. But, let's start by just talking about the basics. What exactly is this multi-asset mutual fund and how do they actually differ from other mutual funds?
Hi, good afternoon. So it's good to be back on the channel and good to be doing this session. So the primary function of a multi-asset fund, which sets itself apart from the traditional mutual funds that we know, whether equity, fixed income or hybrid, is that they got more than 3 assets in it. For example, a typical multi-asset today would have gold, international equity investing, Indian equity and Indian fixed income. You got 4 there. The minute you add another asset, it becomes 5 assets. So the luxury that the investors got is it doesn't have to choose 3 funds, 4 funds, 5 funds. In just one fund, there is a formula that the fund house would have set why these assets will be in the fund and what percentage exposure they'll have. And the third most important is when they will change and increase or decrease the percentage exposure to each asset. So therefore, in the most proverbial way, this is a one fund which can accommodate so many asset categories in just one. So the benefit of the investor is he doesn't have to be chasing different asset classes. In one fund, you got multi-assets working for you.
Absolutely, one fund, multi-assets. If you could just break it down for our viewers as well. You did mention a few of the asset classes that could possibly see an investment, equity, debt, gold. But which are the other asset classes that come into this play?
Okay, so let's break this down. The first things we are all very familiar with are Indian equities and domestic fixed income. Now with that, we had the hybrid funds and the equity or the debt funds. Adding international equity, which is a completely different asset class, negatively correlated to largely our Indian domestic markets, is asset 1. The second asset is gold and silver. Sometimes even adding commodities becomes another asset class. Now, the luxury of this is that we would generally be accessing only fixed income, only equity, or a combination of these two in multi-asset. Gold, silver, international, and commodities become an extra play in the multi-asset funds.
Okay, those are the assets. And is there a specific, norm that comes in or a regulation from the regulator that, they have to invest a specific amount in different asset classes to be called as a multi-asset class, fund?
So the primary cutoff for some fund to be called a multi-asset is it has to have minimum of 3 assets. And there has to be a minimum allocation of 10% to each asset. Over and above that, then it's depending on the positioning of the fund, whether you want debt taxation or equity taxation or how you want to play that. But a minimum of 10% of the asset is mandatorily required to be qualifying as a multi-asset.
Okay, 10% is what they have to look at to qualify and as an investment to be qualified as a multi-asset fund. Obviously, diversification is what we were talking about as well, right now, that it becomes easier in terms of the risk that is there for an investor that surely gets divided. Now, what is this importance of diversification? If you could explain our viewers, why is it so important to actually diversify in this asset class and why does, hence, multi-asset mutual fund become so important?
So diversification is based on the very old adage saying that don't put all your eggs in one basket, which is do not concentrate your risk, spread out your investments and your money in different assets such that not always all the assets will be on the top of their game. There'll be sometimes one asset will be performing. At the same time, another asset will be underperforming or maybe giving you a negative return. The benefit of diversification is to help you ride out this risk, the volatility. Now, as we speak over the past few weeks, we have been seeing risks, we have been seeing volatility, and we were also noticing how fixed income ends up being stable, equity tends up being volatile. Gold and silver on the contrary, are actually giving you a safe, stable to positive return. Now, internationally, the equities are doing completely different from how domestic equities are done. For example, the last 3 to 4 months, Indian equities have been going down, whereas the global US equities have been going up. The benefit of diversification is you get more than one performer working for you, while there be one or two non-performers getting mitigated because the performers and non-performers are together in such a good combination. You get a more holistic, smoother ride out of your investments.
Okay, and obviously, what I want to also know, does this fund actually balance, the risk and return for the investors? How does that come into play? Because at the end of the day, everyone wants that return also coming in. So when everyone is looking at the return, but it's important to notice and balance the risks that are there, given the current scenario, like we were mentioning right now as well. How does it manage this? And is it much of a safer bet for an investor to go for such funds?
Well, first things first, in a good bullish market, nobody likes to look at multi-asset because it doesn't appeal to them. But in markets like this is where multi-assets come up to the front. Because when you put all these assets into place, you'll actually have some kind of a method to put these assets into place. Like a minimum, is 10%, but you could go up to 10, 15, and even higher percentages to any one asset class. Now, when equities are doing well, everybody wants maximum exposure to equity. Or when equities are not doing well, nobody wants exposure to equity. Therefore, you're taking two extreme ends. Either you're going 100% in equities or 100% you want to stay away from equities. That is when multi-assets become very critical, because you've got some allocation to every asset through the market performance cycles. Now, when that happens, you'll notice that the returns are homogenized. You don't get the high end of the returns, you don't get the low end of the returns, you get an above average returns. Now, take a classic example like 2024 calendar year. You had a year where gold gave you 24-25% return. Now, most of you, if you chase gold just because gold gave you return, you'll get stuck. But on the contrary, if you had gold as 10 or 15% as a part of your allocation, in 2024 calendar year, you made money on gold, you made money on equities. So therefore, your returns were definitely greater than just gold, definitely slightly lesser than equity, because a traditional equity or a mid-cap fund would have outperformed the markets. This multi-asset helps you avoid the extremes of the markets, and more importantly, helps you not to ignore an asset or go overboard an asset.
Absolutely. You can't ignore something and you won't go overboard also. So there's not a problem of over diversification that individually, maybe sometimes, investors, if you individually invest, you may over diversify, go in for some particular theme, thinking on your judgment. But obviously, these are fund managers handling it and in a diversified way. So obviously, it's a positive there. Some key advantages, well, obviously, diversification is one of them that, spoken about through this right now. What are the other key advantages that are there for these multi-asset funds in terms of anything, in terms of reducing dependency, in terms of timing the market? Is that also something that comes into play in these funds, and also on the taxation front, anything?
No, you're right. There are many advantages. Let's just go one by one. Number one is the sheer execution strength for an investor. Now, when you come into building a portfolio equivalent to a multi-asset, you'll have to choose an equity fund, you'll have to choose a debt fund, maybe you'll have to choose an international fund, maybe you'll have to choose what category of international fund, and then how much money in gold or silver or any other commodity. In a multi-asset fund, based on the scheme objective, those things are sorted. It is one line item against traditionally 4 or 5 line items that you would need to build your portfolio. So there is great amount of convenience and the benefit of just execution of multi-assets. The second part is the weightages. Now, when one is doing it, like we discussed just recently, we tend to go overboard or we tend to ignore an asset. That doesn't happen in a multi-asset, because at any given point of time, you will have a certain static allocation to every asset. And when the asset prices give you a valuation gap, you can go slightly overweight or slightly underweight. A classic example is that when gold is doing really well, that means you can maybe reduce exposure, and maybe when equities are doing extremely poor, that's when you can, maybe because of valuation supporting or fundamental supporting, increase exposure, which we would not do otherwise naturally, because it's against our instinct to invest in an asset that is not doing well, but in a fund, it works like a charm. Now, the third important aspect is even taxation. Now, some of the multi-assets have gone for an unconstrained access to managing the asset classes, but other group of funds have taken a minimum 65% exposure to equity, the balance 35% which is gold, international and other asset classes. Therefore, you get the benefit of equity taxation. Now, in between this, you also have what we call a multi-asset taxation. Essentially, equity, multi-asset taxation, both are in favor of the investor, where you do not have to worry about the individual asset taxation at a mutual fund route because of the multi-assets being in one. And if you're going in for equity taxation positioning, you get the benefit of taxation. You also get the benefit of multi-asset. Not to forget this, the moves within the asset classes, which is the increase or decrease of weightages, which is what eventually will make you money. Because in the markets, you need conviction, and the conviction is translated into the weight that you have into the asset class.
Absolutely. So that allocation also becomes key, and balancing the portfolio is a key in the right time in the market, and that is why this asset also helps you in diversifying your portfolio as well as managing your risk. But on that note, we're going to take a very short break, viewers. We are understanding what it is. We'll get into more details with Santosh after the break on what these funds can do for you as well going forward. Welcome back to Mutual Fund Corner on CNBC TV18, and thanks for staying tuned. And today we are discussing multi-asset mutual funds and what should investors be doing in a volatile market, and who are the investors who are suitable for this. And that's my next question to you, Santosh. What are the investors, or what kind of investors should actually look at this portfolio or look at such a fund? Any specific goal that they should be having before looking at this fund?
So traditionally, a multi-asset is good for almost every kind of investor, because as you notice that the approach, which is a multi-pronged approach, that is to have multi-assets in one fund, essentially means it can be a significant part of your portfolio because there's nothing that's lacking. The only reason why some investors have to be a little careful while choosing this is, do not expect to be outperforming the market in a good bullish or a momentum-led rally that multi-assets will outperform. See, because you got static allocation to some assets which are not traditionally known to outperform the markets. For example, gold, though calendar year 2024 was a great year, you can't repeatedly having 20-25% kind of returns in gold, because traditionally gold is a hedge against inflation and will give you maybe a good single-digit return. Therefore, a 100% equity fund will outperform. So therefore, for investors seeking safe, stable, good growth over a long period of time, then multi-assets become a great bet. But for those investors who are looking to generate a massive alpha in the medium to long term, or they think that equity is the only asset class that their portfolio risk reward requires, then you will notice that multi-assets may come a little short of expectations, because it is supposed to give you a more homogenized, a more softer move and capture of the markets. Now, this is like, choosing difference between an a la carte versus a buffet. The benefit of a multi-asset is you've got so much going for you, where you don't need your intervention and your monitoring to ensure whether your portfolio is good or bad, because all the good elements are included in the right proportion to make it work for you. So for most investors who are in a dilemma, who do not have maybe an advisor or a distributor to help them manage, multi-assets becomes integral part of their portfolios. But for those investors who are seeking, in volatile markets to contain the volatility or to have a more stable return, then for those investors, multi-assets is good. In fact, in markets like these, where we are in extreme volatility, and we also, not very comfortable going into how the volatility will end. Therefore, multi-assets are a great bet for investors who are looking for an alpha or aggressive exposure. Then maybe this is a second option for people there.
Okay, and what I also want to know is in terms of how multi-asset funds have performed historically versus equity funds or debt funds. Is there something specific in terms of returns that you could highlight?
So I'll tell you, in India, the whole concept of multi-assets fund essentially was only Indian equity, Indian fixed income, and gold. This started about almost a decade ago. But right now, there's so much of positive action there in the mutual fund product category space, where we started including silver last 3 years. We started including international assets. We started having exposure to commodities. Now, what this does is we do not have really long-term averages, but this is comparable to how, if you manage your portfolio with multi-assets, how it's done. Nonetheless, you have good data for 3 to 5 years to tell you that they have consistently been above Nifty, even a 1 year, in a 3 year, and even a 5 year performance. Whereas if you compare this with diversified funds or mid-cap funds, or flexi-cap to multi-cap funds, all of them have beaten Nifty by huge margins. But when you were to take a standalone, today's point in time, Nifty versus multi-assets on a 1 year, 3 year, 5 year category, it's safe to say that they're giving you a decent 10 to 12, maybe even in some cases 14, 15% kind of return. There are some funds which have given you even 18, 20% return against a Nifty being at 8 to 10% return in that 1 to 3 year period. But I don't think this is a fair comparison today that we're looking at. I think over a long term, to expect to be closer to Nifty or slightly over Nifty in terms of outperformance should be the objective of being in funds like this.
Absolutely. And just a last quick question. With the increasing volatility, global uncertainty that we're seeing, do you think multi-asset funds is actually something that in 2025 could pick up pace and gain a lot of traction?
Well, I believe so. That I think that if ever there was a moment for multi-asset funds to do well and to shine and to show what the comprising aspect of multi-assets fund can deliver, 2025 may be that year. So you can't ignore equities, whether international or global or domestic. You got to have some bit of equity exposure there. Likewise, in heightened volatility or uncertainty, fixed income, gold will add stability, and gold will add stability. Fixed income will add stability as well as some income to the portfolio. And also, because these assets are negatively correlated, it reduces your risk. It helps you, breathe easily and not worry about how the volatile markets are maybe, creating a red into your portfolio. Therefore, the way we are currently looking at markets and the way 2025 is possibly going to be poised, I think multi-assets may end up being winners. Because if you go only the fixed income route, you may not be very happy with the outcome. If you only do equity, then you may not be very happy with the volatility. The solution at hand seems to be a good exposure to multi-asset.
Absolutely, Santosh. Thank you so much for joining in with us on the show today. It's a pleasure having you here and understanding multi-asset funds and what they mean for investors in an uncertain market. Thank you so much for that. But that's all the time we have on this edition of Mutual Fund Corner on CNBC TV18. Thank you so much for tuning in.